A startup can be worth almost nothing today and potentially billions tomorrow. That is the entire game. Imagine investing $100,000 into a company when it is worth $2 million. A few years later, that same company is worth $1 billion. Your investment didn't grow because the company paid you a salary. It grew because you owned a piece of the machine. But here's the part most people miss. Startup investing isn't simply about finding the next big company. It's about buying ownership before everyone else realizes what that ownership is worth. And sometimes, investors don't even need the startup to become a billion-dollar company to make millions. So how does this actually work? Why would someone put money into a company that might completely fail? And how can a relatively small investment turn into a fortune? Let's break down the 5 levels of startup investing. Level 1, investors don't buy startups. They buy ownership. When most people hear startup investment, they imagine someone handing a founder a giant check. But that's only half the story. The important question is, what does the investor receive in return? Usually, it's ownership. Imagine a startup is valued at $4 million. An investor puts in $1 million. If the deal is structured at a $4 million pre-money valuation, the company becomes worth $5 million after the investment. The investor effectively owns 20%. Now imagine the company eventually becomes worth $50 million. That 20% stake could theoretically be worth $10 million before accounting for dilution and the exact rights attached to the shares. The investor put in $1 million. The paper value became $10 million. That's a 10 times return. And this is the fundamental engine behind startup investing. Buy a small piece of a potentially enormous company. But there's a problem. The company doesn't usually stay at 100% ownership forever. As it grows, it needs more money. And that creates something called dilution. When a startup raises another round, new shares are issued. Your percentage can fall. You might start with 20%. Then another investor arrives. Then another. Suddenly you own 10%. Then 7%. Then 5%. But here's the strange part. A smaller percentage can still become dramatically more valuable. If your 20% stake was worth $1 million when the company was worth $5 million, and your ownership eventually falls to 5%, but the company becomes worth $1 billion, your 5% is now worth $50 million. So, investors aren't necessarily trying to preserve their percentage. They're trying to increase the value of the entire pie. Level 2. The earlier you invest, the bigger the potential upside. Now we get to the real reason startup investing can produce extraordinary returns. Timing. Imagine 2 investors. Investor A puts $1 million into a startup when it's valued at $5 million. Investor B puts $1 million into the same company several years later when it's valued at $100 million. Both invested the same amount, but their economics are completely different. Investor A bought into the company when the risk was enormous. There may have been no meaningful revenue. Maybe there were only 3 employees. Maybe the product wasn't even finished. Investor B is entering when the company has customers, revenue, employees, and evidence that the business might actually work. The risk is lower, but so is the potential upside. This is why early-stage investors are effectively being paid to take uncertainty. They're betting on something that hasn't been proven yet, and sometimes they get it spectacularly right. Consider companies like Airbnb, Uber, or Facebook. Early investors who bought meaningful stakes before these businesses became household names were taking enormous uncertainty. They weren't buying what the companies were worth today. They were betting on what they could become. That's the key psychological difference. Public market investors often ask, how much is this company worth? Startup investors also ask, what could this company become? And that distinction can create enormous returns, but it also creates enormous losses. Because for every startup that becomes a global giant, there are countless others that never get there. Level 3. Investors don't need every startup to win. Here's where venture capital gets really interesting. A professional startup investor might invest in dozens of companies, and many of them can fail completely. The investor might lose 100% of the money invested in some companies. So why do it? Because startup returns can have a power law distribution. One massive winner can potentially make up for many failures. Imagine an investor puts $1 million into 10 startups. That's $10 million invested. Suppose 7 companies fail, 3 survive. 2 eventually return $2 million each. The portfolio has recovered $4 million from those 4 companies. But then the 10th company becomes enormous. That one investment eventually returns $50 million. Suddenly, the investor has received $54 million from a $10 million portfolio. The investor didn't need 10 winners. They needed one extraordinary winner. This changes how professional investors think. They're not necessarily asking, will every company succeed? They're asking, could this company become so successful that it changes the entire portfolio? That's why venture capital can look irrational from the outside. An investor might knowingly accept a high probability of failure because they're hunting for an outcome that is disproportionately large. This is also why diversification matters. An individual angel investor putting their entire savings into one startup is playing a completely different game from a venture capital fund investing across dozens of companies. The risks are fundamentally different, and the biggest winners often determine the final result. Level 4. The secret is often in the deal. Now here's where startup investing becomes much more sophisticated. Two investors can put the same amount of money into the same company and still walk away with very different outcomes. Why? Because the terms matter. Consider preferred shares. Certain investors may negotiate protections that give them priority if the company is sold. One common concept is a liquidation preference. Imagine an investor puts $10 million into a startup. Later, the company is sold for $15 million. The investor may have contractual rights that affect how that $15 million gets distributed. In many venture deals, a one-times liquidation preference means the investor can potentially receive their original investment before common shareholders receive proceeds, depending on the exact terms. Now compare that with a $1 billion exit. Suddenly, the preference becomes much less important. The investor may convert to common and participate in the huge upside. This reveals something important. Startup investing isn't just, how much of the company do I own? It's also, what rights come with what I own? And then there's another mechanism, the SAFE. A SAFE stands for Simple Agreement for Future Equity. Instead of immediately issuing traditional shares, a startup can raise money through a SAFE that later converts into equity under specified terms. Y Combinator helped popularize the SAFE, and its current documentation includes structures involving valuation caps, discounts, and other provisions. Y Combinator. For example, an investor might put $500,000 into a startup through a SAFE with a valuation cap. If the startup later raises money at a much higher valuation, that earlier investor may convert based on the agreed terms. In other words, early risk can come with better economics. The investor takes the uncertainty. The contract determines how much of the future upside they can capture. But even then, there is one final piece of the puzzle. Level 5, the investor has to get out. This is the part many people misunderstand. An investor can own 5% of a startup worth $1 billion and still not have $50 million sitting in their bank account. Why? Because the shares may be private and illiquid. The company has to create a liquidity event. This usually happens through an acquisition, an IPO, or sometimes a secondary transaction or share buyback. Let's say an investor owns shares in a startup. A larger company comes along and offers to acquire the startup for $500 million. Now, the theoretical value of those shares can become real money. The acquisition creates the exit. The investor receives proceeds according to the ownership structure and the terms of their securities. The same thing can happen through an IPO. The company becomes publicly traded. The investor's private shares can eventually become publicly tradable, subject to applicable restrictions. And suddenly, the investment that existed on a spreadsheet for years can become liquid wealth. This is why startup investing can require enormous patience. You might invest today, wait 5 years, 7 years, or longer before the outcome becomes clear. And sometimes there is no outcome. The company simply dies. Your investment goes to zero. That's the uncomfortable truth behind the glamorous stories. For every famous early investor who turned a small check into millions, there are investments nobody talks about. The startups that ran out of cash, the products nobody wanted, the founders who couldn't scale, the markets that disappeared, the competitors that won, the investments that quietly became worthless. Conclusion: the real business is buying the future. So how do investors actually make money from startups? The formula sounds simple. Invest early, buy ownership, help the company grow, survive dilution, protect the investment with smart deal terms, and eventually, sell when the company becomes valuable enough to create a liquidity event. But underneath all of this is something much deeper. Startup investing is essentially a bet on the future. Investors are buying something that doesn't fully exist yet. A future product, a future customer base, a future market, a future company, and that's why the biggest fortunes aren't always created by working for the company. Sometimes, they're created by owning the company before everyone else understands its potential. But there's a final lesson. The goal isn't simply to find a startup that looks exciting. It's to understand the relationship between risk, ownership, valuation, dilution, time, and probability. Because a company can grow 10 times, while your investment doesn't. A startup can be worth $1 billion, while shareholders receive far less than expected. And a tiny early investment can become a fortune, if the right company, the right deal, and the right timing all collide. That's the real game. Investors aren't just buying businesses, they're buying pieces of possible futures. And in the world of startups, the biggest fortunes are often made by the people who can recognize that future before everyone else does.